Okay, so let's come over to the backtester. So the first thing is that copy the so-called codes here, and we're gonna bring it over and basically download it into our tier sheet. And once that's fully downloaded, we're gonna run and create the so-called tier sheet itself. So this is a built-in function in Quantopian. It's called PyFolio. And let's look at this period that we actually ran our backtest from 2014 December until 2016 February. So the annual return is not very high, although you can actually apply leverage to increase it. Sharp ratio is 0.84. Again, one of these things is that I do want to stress that this is a single alpha. You will not likely to run in this day and age, you will not run one single alpha on its own. You are likely to use multiple alphas to basically provide a greater stability to your portfolio. That's one. Two is that it increases your returns by having multiple alphas. So this is one alpha that I'm trying to illustrate to you, and I strongly encourage you to apply more alphas before you actually turn it into so-called real run your portfolio in the real market. Okay, so the Sharpe ratio is 0.84. The common is 0.75. The solid node is better, it's 1.21. The skew is on the negative side, which is not very attractive in that sense. However, overall is that it still have alpha of 0.05, 3%, and information ratio of 3%. The beta, as I mentioned before, is very attractive, being absolutely neutral to the market. So if you look at the net drawdown in terms of the worst period, is down 6% from 2015 January until 2015 May. That's the valley. Sorry, the recovery date is August. So the whole duration is 144 days. So there are periods that it underperforms. So that's from where's the underwater plot? I think it doesn't have an underwater. There's the underwater plot. So this is the longest drawdown period here. What is the underwater plot? Basically, from peak to making the new peak, that's the whole period of underwater. It's not so much that it is losing money. It's basically when is the next time that it crosses over the previous peak. So it's important to bear that in mind. Otherwise, you think that it's always losing money. That's not the case here. It's basically from peak to peak. When is the next time that you exceeded the previous peak? So that's really the drawdown or the drawdown period here. So the worst drawdown is only down 6%. If you look at the S&P 500, as I mentioned before, from that period to that period, there it's a drop of roughly 10%. From the starting point is a drawdown close to 8.5%. So and the S&P 500 dropped between 8 and 7% 3 times during this period of backtest. So it's much more hair-raising and gut-wrenching than this Algo. Other things to look at is that the cumulative returns volatility matched to the benchmark. This is a plot whereby if you match the volatility of this Algo to the benchmark, what you get is the returns of close to 15%. So we are trying to compare apple to apple, same volatility. What kind of returns would you actually get from this Algo? Is actually up to 15%, whereby the so-called S&P dropped 5% on the relative term. So if you compare, this Algo is up 20%, is extremely attractive compared to at the end of the period compared to S&P 500. So basically, if you look at this next thing here, is that the cumulative returns. Unfortunately, this thing is on log scale, so you can't really see much in the way of difference. This is probably a better comparison. This was useful when it's run on a longer time horizon. We only ran it for a year and 3 months, so it's not so obvious. So looking at the returns here in terms of the so-called distribution, if you picture this in a histogram probability distribution curve, you can see the long tail here. Otherwise, the rest is fairly, I would say 90% of it is between up 10% and down 10%, with the exception of this spike down here. So it pays to actually investigate what actually took place here. It'd be interesting to find out what really actually happened during that period. We won't go into it here, but it pays to actually understand what it really took place. That's to improve your so-called alpha and also your Sharpe ratio long term. So the rolling beta basis, you can see, as I mentioned before, it's basically uncorrelated. Okay, so that's really the distinctively attractive feature of this algo trading with sentiment. The rolling Sharpe is pretty healthy. It averaged around the later period. It was actually slow to start, but once you actually kicked into gear, it's on a rolling basis around 1.5. For the whole period, the actual Sharpe is a little bit lower at around 0.84, if I remember correctly. This is from a factor exposure basis. It does have some exposure to this high growth as well as the momentum. The high growth is negatively correlated to the high growth stocks, and also momentum positively correlated to the momentum, not so much to the small caps in this case. Partially, this has to do with the fact that we actually did filter it using our universe to Q1500. We excluded a lot of the small caps, which is why the small caps does not really feature it here. I already touched on the drawdown and also the underwater plot. This is the monthly returns and the annual returns. 2014 was down. Mind you, it was we only ran for December, so the December period was down, which is actually the minus 0.3 here. We were up in 2015 and up so far in 2016. The distribution of monthly returns is similar to the plot that we showed earlier, which is this one here. Most of it is between, this is on a monthly basis, so if you look at there's actually a negative spike here, hence the reason for the negative skew. But the mean is definitely on the positive side, but it does have quite a large distribution. That's one thing to keep in mind. During some of the stress period, if you look at the 4 period, the algo just basically stay put. S&P was down, hovering around minus 8%. Under the new normal, it took a wee while for the algo to adjust, but it actually took off towards the later period. Top long 2%, that's great. Top short is also 2%. Top 10 position 2%. Now this is what I really like about this algo, is that the exposure is at most 2.3%. And that is really great. The last thing you want is have more than 3%. If you look at a lot of the investment statements or portfolio intent for a lot of the portfolio managers, especially some of the larger ones, they have very strict requirements that the exposure to single stock is really low and or less than 3%. In this case, this algo actually fulfill that requirement. So from an exposure point of view, we are long about 100% and we're short about 100%. Net is actually close to zero. That's the whole point of the long short portfolio allocations. There are periods that we don't have allocations, so hence there are empty period here, like that period there. Right, the long short. There's also the median positions. Top holdings per day is around 510 to 520. So that's both on the long and short. And if you look at this, we have more longs than shorts, but that's okay. That's not really that major. The gross leverage is around 2. It does have small spike up to 2.06 and small spike down to 1.94, which is not major once again. The daily turnover, it's around 20%. On a daily basis, which is fairly substantial. Daily trading volume is about 20,000 stocks, but this one is kind of hard to read because it really depends on the share price as well to make that the meaningful interpretation. Distribution of daily turnover is around 20 to 40%, so with the mean around, I think that's more like 32-3%, and the transaction mostly is distributed around 10:30 until 10. Looks like this is in basically it's about 10:50, and that's pretty good. This is part of our design because we used the Q1500 universe. If you had used the whole universe, you're likely to have the whole distribution with a massive long tail and might not have some position close at all at the end of the day? The answer is really simple. If you trade illiquid stocks, being illiquid doesn't allow you to enter or exit at all, and that's the last thing that you want, and that really actually corrupt your alpha signal. So that's really the end of the Centex algorithm. It's really an initial part to the whole. This is really the beginning of the part of the analysis. As I mentioned before, these are preliminary examination. You can trade the signal just on its own. That's one way. There are other ways to trade, basically using sentiment to overlay in terms as a provided, use it as an overlay to to check on the volatility. You can use it as to support your mean reversion or momentum. There are plenty of research online. If you Google it, you will find that a lot of them provide so-called support that sentiment analysis can provide as a filter to improve your returns on momentum stocks if you're trading a momentum strategy, as well as mean reversion as well. It's a fantastic tool for that. I'll leave that to you to study that. But for now, I encourage you to play around with the so-called signals that's provided by Centex. It's fantastic for basically to learn. And if you are interested in this, it's not very expensive to subscribe on the Quantopian platform. It's really only $10 per month, and I strongly encourage you to play around with it and reach out to the author and creator of Centex as well, Harrison. He's a fantastic guy. He has a YouTube channel and he has plenty of tutorials on it, and he's a nice guy as well. So that's all for now. I'm going to sign off, and thank you for watching the videos, and I look forward to hearing some feedback from you on these videos.